Thanks for joining in. So I guess there's a little bit of background on the firm. We've basically built an application that is designed to make it easy for investment managers to incorporate machine learning and alternative sets of data into their process. We have about 40 clients spread across APAC, the US, into Europe. And we have a fairly large variety of clients. Our biggest client is like a $400 billion long-only shop, and that runs the gamut all the way down to sort of smaller 30 million sized family offices. So we have a fairly broad exposure to some of the different ways that firms have been successfully using these data sets and machine learning techniques in their process. So I wanted to give kind of a high-level view of some of the ways that these systems can be useful, some of the ways that it is different from some of the more traditional approaches, and that I really wanted to set sort of the groundwork for future talks where I'll be going into a lot more technical depth on how to actually solve some of the fundamental problems I'll be talking about today. So just really quickly, if we want to, from a high level, kind of go through the presentation, I'll be talking a little bit about why we think the future is a combination of human and machine learning working together. I'm going to talk a little bit about the Boosted platform and how we sort of fit into that ecosystem. I'm going to be talking a little bit about sort of machine learning, some of the newer data sets, and how we really think it's quite different from more traditional linear quantitative techniques. I'm going to go through a specific example of applying these techniques to the Russell 1K, and then I'll lay some of the groundwork for future webinars. I'll talk a little bit about some of the problems with data around look-ahead bias, survivorship bias. I'll be talking a little bit about interpretable AI and how we see that as very critical to the investment process. But I really won't be going into a huge amount of depth on those topics today, more just leaving the groundwork for future talks. So just, to really sort of start off and motivate this, why human plus machine learning? Well, fundamentally, I believe that by far the biggest opportunity right now in the investment space is actually around the adoption of machine learning. And I think it's really interesting because we're at this point where it's actually possible to apply these techniques in a way it really wasn't historically possible. If we jump into the 90s, I'd argue Renaissance Technology was probably one of the very first firms to start using some of these techniques in their process. And in a lot of cases, they actually needed to go out and source the data themselves. They needed to do most of the data cleaning. They actually built, off themselves, their own database, which survives to this day. As you start getting into 2000s, a lot of the more traditional data sets started to become much more digitized. We can go out into Thomson Reuters, Bloomberg, and there's actually starting to get APIs, and I can start getting access to the balance sheet and analysts in a more direct data feed component. But in the 2010s, we've seen this sort of explosion of alternative data sets, geolocation data, market moving news, even things you wouldn't think of like truck boards, satellite imagery, cargo manifests, what vessels are headed where and what they're carrying. All of a sudden in the 2010s, these data sets started to grow, but most of them haven't traditionally been very mature. Machine learning arguably needs a few years of data before it can really start to learn lessons. And so in the early 2000s, it was humans that were really starting to use these data sets and take advantage of it. And I think in the 2020s, it's fascinating because we're finally getting to the point where these alternative data sets are rich and mature enough that the machine can start to really take advantage of. So fundamentally, I think that this is going to be the biggest disruptive force over the next 10 years. And statistically, if you're in this call, you actually probably agree with me. I think like 87% of family offices believe that AI is going to be the single biggest disruptive force. 80% of institutional investors believe that this technology is going to fundamentally change the industry. And what is most fascinating for me is only 10% of the industry is actually using machine learning as a core part of the portfolio construction process or the stock picking process. So everyone kind of agrees this is where the industry is going to go. but the vast majority of people aren't there yet. And so for us, building a product that helped you sort of get ahead of the curve and integrate this into your investment process early, we saw as a very large opportunity. And sort of to, illustrate why machine learning can be additive to the human process, humans have some innate advantages over the machine. We can be extremely creative, novel. We can operate in conditions where we don't have access to a huge amount of data. Machine learning kind of famously needs a ridiculous amount of data in order to learn and make predictions about it. But on the flip side, there's a limit to how much data we can think about and analyze at any given time. And it's hard not to run into different biases. No matter how long you've been doing this, no matter how many times you've been burnt, we all have a tendency to confirmation bias, sunk cost, the tendency to hold on to things too long, or maybe not buy a stock as quickly as we want, and the tendency to find data that backs up hypothesis we already have, instead of doing it the other way around and using data to come up with a hypothesis in the first case. On the flip side, machine learning can process a truly staggering amount of data and can analyze the space in a way that is just not possible for a human. We take a look at a Boosted.ai model built on the S&P 500. We're basically comparing every company to every other company. So that's about 250,000 comparisons. And we're doing those 250,000 comparisons across potentially dozens or even hundreds of different variables. So you're looking at, math in the order of millions of different computations that are being done. And hypothetically, any human could come in and compare one company to another company and probably come up with a better conclusion than the machine. But the machine's capacity to just analyze so much information all at once far outstrips any human capacity. And then as part of that, because it's analyzing so much information, it can learn a degree of nuance that a human maybe wouldn't be able to learn. A human, as an example, might say, I think price to earnings ratio is a good measure of if a stock is expensive or cheap. The machine might figure out, well, that's true if you're dealing with an industrial company or materials. But if I'm dealing with a technology company, maybe price earnings growth is a better measure. Just as kind of a throwaway example. On the flip side, there are some significant weaknesses to machines, especially in this domain. Machines have a tendency to potentially overfit or p-val hack, where if you go out and you do millions and millions of simulations, just by random chance, a subportion of those simulations are going to look good, but they could just be purely spurious. If you're not accounting for the statistical significance of what you've done, if you don't go in with a very strong hypothesis around why the set of variables you're looking at are potentially useful, if you just sort of throw thousands or millions of data sets blindly, there's a high chance that any backtest you produce from that is going to be spurious. And then on the flip side, humans can understand and make intuitive decisions in a space where the machine doesn't have access to it. In the case where there's a regime shift, such as we saw in 2020, or where a stock is behaving completely differently than its historical norm, there are cases where a human can actually come in and make a better decision than the machine. So fundamentally, we think the future is a combination of both of these strengths. We built a system where a user can come in, they'll tell the system, here's the set of variables that I think are important. Here is the thing I'm trying to predict. The machine's going to go through the data, figure out patterns, and then spit back recommendations. And really importantly, it's not going to just spit back recommendations blindly and say, here's a stock I think you should buy, or here's a stock I think you should sell. It's going to say, here's a stock I think you should buy, and here's why. And here's a stock I think you should sell, and here's why. Here's the pattern that I learned from the underlying data. And by doing that, the machine can start to look at things that you maybe wouldn't have considered as a human. But it also gives you these kind of strings that you can pull on to go in and do your own kind of analysis. So the machine may pop up, here's a company that's prospective buy that you haven't thought about, or here's a prospective risk that you haven't thought about. And then the human can come in and sort of add their own overlay of their own set of logic. To use a specific example, maybe you believe that there's some alpha sitting in credit card data. You can come into our system and You could say, I want you to find companies that are most likely to beat earnings. And you could give the system credit card data. You could give the system earnings data, balance sheet data, maybe market moving news. The system will go out and say, okay, here's the top 100 companies that are most likely to beat earnings. And here's the top companies that are most likely to lose to earnings. And here's why. Here's the specific pattern that we picked out on it. So if we actually want to sort of take this into a specific approach, I would argue this is closest to quantamental. So humans come in, you can sort of input your fundamental thesis, the perspective that you already have on the world and what drives things. You can tell the system the set of data you want to look for. You can tell the system what it is that you're trying to predict, right? What you're trying to predict could be pure alpha. It could be trying to predict revenue. It could be trying to predict volatility. It could be trying to predict which company is most likely to buy back earnings, buy back stock. It could be literally thousands of different things, but you come into the system, you tell it, here's what I'm trying to predict. Here's my hypothesis around the set of data that I think is going to be most useful. And the machine's going to go out. It's going to learn from that data. It's going to figure out the best patterns, and then it's going to report back. Here's the set of things I want to buy. Here's the set of things I think you should sell. And here's why. Here's where it came from. And, just really, really kind of quickly talking at a high level, there's a lot of advantages of incorporating these techniques. One thing is we've seen this massive explosion of different data sets. And without using more quantitative machine learning driven approaches, it can be rather difficult to incorporate these things in, right? If you go out and you buy a gigabyte of credit card data, on its own, it's actually somewhat difficult to use. But if you take that credit card data and you suddenly use it to predict earnings, or you take that credit card data and you use it to predict volatility, suddenly you have an actual signal that you can incorporate into your process fairly easily. So it lets you take advantage of this massive growth of different data sets. It can give you points that you maybe haven't considered. So it might give you breakout signals, or it might tell you about a stock that it thinks is likely going to tank or torpedo, where you might have it as a current long position, and it might be surfacing information to you that you hadn't previously thought about. And then finally, it can really help you sort of remove your own biases, because it's analyzing information in a purely objective fashion, and because it's analyzing it from a perspective different way than the human is. It can help you find points where you maybe have hidden assumptions, and it can help reveal patterns that you maybe hadn't considered in terms of driving your decision-making process. And so we actually start to think about, what this can mean over the next 10 years. It's really fascinating to me because the alternative data space has been exploding. The expenditure on it has grown 10% in the past 4 years. As of 2020, 50% of hedge funds are actually incorporating alternative data. The spend has gone up to 1.7 billion as of 2020, and it's expected to grow 40% for the next decade, up until it hits the tens of billions range. So you have a lot of people already using alternative data. You have this huge explosion of the amount of providers of the data. You have this huge explosion of the total budget of the data. But like I said before, only 10% of the industry is actually using machine learning to analyze these sets of data. And so you're at this point where a lot of people are able to get this surface level information, but there's a lot of nuance underlying the data sets that you really need more advanced techniques to use. If we take a look again at credit card data, when credit card data first came out, probably it provided a lot of alpha, probably it provided a lot of information. But as time's gone on, analysts have actually started to incorporate that into their predictions. And so there's this connection between analysts and credit card data that if you're just looking at one or the other, you won't necessarily capture. There are sets of data that are going to be more useful in some cases than other cases. If we look at something like market moving news, it actually tends to do a relatively okay job predicting certain larger cap companies. But when you start looking at mid caps or small caps, there's less coverage around it, and the signal can start to become a lot weaker. And so we're in this fascinating spot where you see this huge explosion of these different data sets, but the vast majority of people using it are still using it in fairly simplistic ways. And so we have this huge opportunity to use more advanced techniques to capture nuance, sort of long-range connections, to drive better performance and just in general sort of enhance the decision-making process. So this really heavily motivates our process and how we think about it. And we basically have a system that's designed to make it easy for you to come in, supply the set of data that you think is useful, tell the system what it is that you're trying to predict, sort of combine your knowledge into it, have the system spit back recommendations, and then sort of incorporate those recommendations into your process. And so just for some of the people that just joined, to kind of walk through another example, you might come into our system and say, I want to make a prediction about which company is most likely to beat earnings, or I want to make a prediction about companies that are most likely to see some alpha or some volatility. You'd come into the system to give it credit card data, maybe give it some geolocation data, maybe you give it market moving news data, maybe you give it some analyst data, balance sheet data, and the other side of the system, find the companies that are most likely to beat earnings. The system will go out, make a prediction about the top 100 companies most likely to beat earnings, the top 100 companies most likely to lose earnings, and then explain here's why. Here's the pattern that we learned from the data that you provide that led us to that conclusion. And just as a really quick background on our experience, how it is we were able to build this. As Eric alluded to, I started my career by co-founding a deep learning company that ultimately became a division of Microsoft Research. We took some of the founding members of the earliest Bloomberg machine learning groups. We brought them in here. But we also have a lot of people that come from more fundamental backgrounds. So we have a few portfolio managers working for us that actually used to work directly for Julian at Tiger. We have people that have worked at more traditional fundamental shops. We have some people that have worked at shops that are more directly quantitative. We have people that come from the technology sector. So we've been in a really good spot to sort of incorporate some of the most advanced machine learning in the world, but build it in such a way that's really useful for sort of everyday fundamental portfolio managers. Today, about 80% of our users are actually fundamental. 20% are quantitative, and we do have some full quants that are using our system end to end, but it's really designed to be this very simple, easy point and click interface that integrates really well with more traditional fundamental approach. And to sort of break down how we think about the process, we really think about it in two different ways, and then we kind of break those ways into two different subparts. So the first question is basically around building a model that can make predictions about rankings across a specific universe of stocks. So you'll come in, you'll give the system data, you'll tell the system what you're trying to predict, and then it's going to go out and it's going to basically rate the stocks. So once you have that, we can then come in and we can evaluate the power of that signal on its own. And if you've done a good job building your model, then the top 20% of stocks should have a higher return than the next 20% of stocks, should have a higher return than the next 20% of stocks, all the way down to the bottom. And at this point, we can come in and we go into the second part of the problem, which is really around portfolio construction. Once I have 100 stocks that I want to prospectively buy, or maybe 200 stocks I want to buy, and I have 100 stocks that I prospectively want to short, how do I actually want to build my portfolio? Am I going long short? Am I net neutral? Am I long only? Do I want to minimize my volatility? Do I want to maximize my Sharpe? Do I just want to reduce the probability of a drawdown, regardless of what my Sharpe or information ratio looks like? Do I want exposure to risk factors, or do I want to risk mitigate things out like momentum? And what gets really, really fascinating on the portfolio construction side is that not only can you come in and start doing things like risk mitigating momentum and volatility and size and all those traditional bar factors, but probably our by far most popular use case in 2020 was actually using our system to risk mitigate these non-traditional risk factors. So I would argue something like COVID was impossible to model with traditional quantitative techniques. And I'll talk a little bit about why in a few slides. But using our system, some of these alternative data sets, believe it or not, it's actually possible to model COVID as a risk factor. It's possible to take a look at the vaccine as a risk factor. And even a lot of the retail risk that happened in the beginning of 2021, believe it or not, that's also possible to be motivated as a risk factor. And so first part is, using these alternative data sets or some more traditional data sets, making predictions about set of stocks. And the second part is building a portfolio, constructing it to match your mandate, and then risk mitigating it to get to the point where you want. It's something I'll just really quickly kind of touch on the portfolio side. We have a huge variety of use cases. We have some clients that have turnover of like 30, 40%, buy and hold, very long-term thinking. And then we have other clients that come into the system that have turnover of 4,000 or 5,000% daily trading, turning over the entire portfolio. And believe it or not, you can actually apply these techniques to both cases. And so just really quickly, kind of talking about the platform at a high level. We built it in a way where it's designed to be extremely easy to use. It's complementary. It integrates into the investment process in a few different ways. It's cutting edge. As I mentioned, we have, I would argue, one of the best teams in the world because we combine some really, really strong machine learning talent with some really, really strong fundamental talent. So we have a lot of very finance specific built ML, and then it's designed to be explainable. It'll actually tell you this is what's driving our decision-making process. And I want to talk about the finance specific element of it for a minute. A lot of people that have tried to sort of tackle machine learning in finance often will take a traditional algorithm off the shelf and then just assume it'll work for the space. And the reality is the vast majority of even historical machine learning actually doesn't work too well out of the gate. There's kind of three main reasons for that. The first is, if I think about traditional machine learning, things like image recognition. When I'm looking at a picture and I want to figure out if that picture is a cat, we can get to about 95 or 98% accuracy on making a prediction if a picture is a cat. When my Tesla is doing autopilot, I really want to make sure that that is 99.9% accurate in figuring out where the road is. If my car is less than 1% accurate in predicting where the road is, I'm having a really bad day. And so traditional machine learning is designed for relatively high fidelity in the decision-making process. In this space, if you are 55% accurate in predicting stocks that are going to beat the benchmark, and you're 55% accurate in predicting stocks that are going to lose to the benchmark, you are a rock star. You are one of the top portfolio managers in the world. And so if you try to take these traditional techniques that are designed for these really high fidelity cases, and you try to throw them into this situation with this extremely high noise to signal ratio, the reality is the vast majority of them are going to break down. We're going to disperse results are just not going to work out very well. The other problem is it is very easy to create a statistical trap in this space. As I mentioned before, if you go out and you do a million sort of random walks, random simulations, by random chance, 5% of them are going to look great. And if you did it that way, you have no idea if that 5% that you found that were good were just sort of random coincidence or if they were actually real. So you have to be accounting for the statistical significance of what you're doing. And then finally, there's just a huge amount of problem with the data themselves. There's a lot of data sets, especially alternative data sets, where they only have currently active tickers. And so if you just blindly use that data, the machine's going to learn, oh, if I have this data, I'm never going to go bankrupt. And that's not actually true. It's just you don't have any example of bankrupt companies in your data set. Or another example is you'll often have this sort of look ahead bias where data set providers will tell you that, yeah, the market would have seen this on January 3rd, but in actuality, there's no way it would have seen it until a few weeks later. And if you're not accounting for these things, if you're not analyzing the data, again, you're going to have really bad results. You might have a fantastic back test, but your actual sort of live results are going to be terrible. And so when I say that we have a lot of proprietary finance-specific machine learning, that's really what I'm talking about. We really had to build a lot of things from the ground up that just doesn't really exist elsewhere. So in terms of how that process works, though, all this complexity is kind of hidden. You don't really need to think about it very much. You just come into the system, you tell it, here's the stock universe that I care about. Here is the data, the set of features that I want to look at. I want you to look at PE ratio. I want you to look at PEG. I want you to look at the balance sheet. I want you to look at market moving news. I want you to look at geolocation data. I want you to look at credit card data. I want you to look at truck boards, whatever it is. You come in, you tell the system, here's the set of data that I think is important. Here's the stock universe that I want to apply it to. And here's what my mandate is. Here's what my restrictions are on my portfolio. Am I going long, short? Do I have a certain amount of tracking error to the S&P 500? Do I not care about tracking error? Maybe I just want to maximize my Sharpe. Do I have turnover constraints? Is there carrying capacity of the portfolio? What is that capacity, et cetera, et cetera? So you come in, you really tell the system, the universe, the set of data and features you want it to look at, what the constraints of your mandate are. And this is all very simple, very easy, point and click. The machine's going to go out through the data. It's going to identify and find patterns in the data based on the unique set of input that you've given. It's going to make predictions back. You can then take those predictions, and if you want, you can use it for sort of idea generation, or you can plug this in or plug your own signals in and actually use the systems to directly do portfolio construction. And then you can go back in time to sort of analyze the historical performance. And again, without going into too much detail, I'll just say that we have done a lot of work on the way that we backtest. And I think generally speaking, there's an assumption that any backtest is not going to perform the same well live. We actually find it's really, really hard in our system to build a good backtest. But if you do build a really good backtest, the live performance tends to align pretty well because of all the different controls around data, significance, et cetera, that we've built in. And so just to really quickly sort of talk about what those different use cases look like and how people are incorporating this into this process. I would say there's really 6 that are really popular. The first is almost like a dynamic stock screening. So using the system to identify torpedoes before they come torpedoes, right? If there's a stock that you're maybe long on that the system hates, this is a good warning. And maybe you still like the stock, but it tells you there's a risk premium and what's driving that risk premium. Finding prospective new buy ideas, find prospective short ideas. And actually, in a lot of cases, we find there are clients that are extremely good on the long side, but they can use a little bit of help with the short book. And our system can help a lot with that. It does a very good idea at sort of dynamically finding short opportunities and doing a lot more detailed analysis on that. Another, and I'd actually probably say that the single most popular use case is actually around what I'm going to call a machine learning overlay. So generally speaking, what this means is we'll have clients that'll come in, they'll have their own portfolio, they'll have their own set of stocks that they want to go long or they want to go short with, but they could use a little bit of help with the sizing. So maybe you have a set of stocks you want to go long, a set of stocks you want to go short on. And then you'll just combine machine learning with that. So what'll happen is if the machine really likes a stock and you really like a stock, it'll increase the weight a little bit. If the machine hates a stock and you hate a stock, it'll go more short or decrease the weight a little bit. And then in the case where there's sort of ambiguity between the human and the machine process, that'll sort of revert the weight a little bit to the mean. So that on its own, we have found it can actually add a lot of alpha. And by definition, keeps your existing mandate because it's keeping the same set of stocks that you care about. But you can also come into that and you can use the overlay in different ways. Maybe you don't care about alpha prediction, but maybe you have a current set of stocks and you want to risk mitigate your short book to prevent a blow up like happened in January and Feb. Or maybe you want to risk mitigate out something like COVID exposure or exposure to a vaccine or bounce back. You can do that kind of thing. Or you just want to come into our system, again, take your current stock and you just want to apply some kind of different optimization. Maybe you want to minimize the skew over time or maximize your Sharpe or reduce the probability of a drawdown or, all these different kinds of things. So I'd say that's by far the most popular use case. You come into the system, you input the set of stocks portfolio that you currently have, and then you just use the machine to help with the sizing. And then, in cases where you and the machine disagree, it can really highlight that. You can go in, you can really see what is the data, what is the pattern that the machine looked at that I'm not aware of. And that gives you a chance to do a little bit more sort of fundamental research as well. We actually have some clients that will sort of create a end-to-end entire portfolio in our system. So they'll come in, they'll input the data, they'll input the objective, they'll do the portfolio construction, and then they'll actually get a full-blown portfolio that they can run. And we have quite a few clients that are running money on that directly. It's a very solid use case. And then we have some people that are just using the system as kind of, almost like a factor analysis. So they don't want the system to decide how to change the sizing. They don't want the system to decide, which stocks to dynamically change. But they might ask, where are my risk exposures, right? And again, the risk exposures could be things like traditional bar risk factors, but it could also be things like, what are my exposures to non-standard risk factors that are occurring in the market today? And again, I'll keep tying back to COVID because it's just a popular case, but there could be other times of sort of dynamic risks that are occurring. And then finally, we have a lot of users that are kind of sitting on dozens or even hundreds of data sets. And the question that they're asking is, which one of these data sets are worth paying for? Which one of these data sets actually have predictive value at alpha? And which ones, are suffering from problems like survivorship bias or look-ahead bias or other forms of, anomalous biases that are formed in. There was one data provider that we looked at where they claimed to have full coverage of the US, but 80% of the data was actually based out of New York. And so if you're using that data set, you'll find that the machine will become a lot more confident about New York companies and a lot less confident about companies that trade heavily in the Midwest, like, say, Walmart. And if you're not aware of that bias, the data may look good, but in reality, it just created a bias to certain types of companies. And by random chance, those types of companies have done well. And so that's another really common use case. We'll have clients that'll come in and with potentially a few dozen data sets, and they'll say which one of these are useful, what are the problems in the data, and then at that point they can go out and use the data on their own. So by far the most popular use cases, but there's kind of a plethora of different things you could do even beyond what I'm talking about here. And just to sort of tie this back into an example, this is an example of a model that was built by someone using the platform. And these are very simple features. Again, if you were incorporating your own features, you might have some things that are a little bit more exotic. But on the left side here, we can see the sets of different factors that the machine were given. The size of these factors indicates how important they were to the machine at that given point in time. But what's actually really interesting is the distance between these variables actually indicates how much the machine is using them together. So this is telling us analyst expectations is important, but analyst expectations is important when you combine it with the operating cash flow to price. The 12 minus 1 price momentum is important, but it's important when you combine it with the market cap. And the market cap's important, but it's important, again, relative to the price momentum, relative to assets to price ratio, and fascinatingly enough, relative to the Japan-US foreign exchange rate. And so you can start to see some of the ways that the model's looking at the world, and it can start to tell a little bit of a story. But then you can actually dive into the individual predictions, and the system will start telling you, this is exactly what drove why I'm buying or potentially want to sell this particular stock. These were all predictions that were made on the same day. Green here means that it is a feature that led to it being more likely. Red actually means that it detracted. It means, this is maybe something, a little bit of a risk that you might have to look at. This is something that maybe disagrees with my underlying thesis. The number of stars is basically indicative of if it's a buy or sell. So a short here would show up as 0 stars. Stronger buy would show up as 5 stars. And you can start to see, again, kind of some of the really interesting stories that it'll tell. So taking a look at this top stock, it thinks that it's a good buy because analysts love this stock, but the 9-month price momentum has actually been down. So relative to itself and relative to its peers, this stock is quite low, and it's been going quite low for a while. But all of a sudden, analysts have started to really love the stock relative to what they thought about it historically. So it sees a sort of separation between how analysts are viewing the stock versus how the stock has actually moved as a prospective opportunity. And you can, again, it's kind of interesting. You can actually see across these 3 different stocks, again, it's the same model. It actually picked up on different patterns for each of them. If we were thinking about like a traditional linear regression, all 3 stocks would have the same set of variables that were driving them. But here you can see that this system's actually picking up on a bit of nuance, and it's picking different patterns from different stocks. Now that same pattern might appear twice. There might be 2 stocks that are both strong buys because they're sort of following the same historically identified pattern. But you can also end up in situations where you'll have these very different dynamic patterns. The system might, as an example, figure out that if you're large cap and in the technology sector, momentum is a good thing. But if you're medium-sized in the technology sector, maybe momentum's not a good thing. It could figure out that price to earnings is potentially a really good indicator if you're a materials company or an industrial company, but maybe price to earnings is not great for a technology company and you need something like price to earnings growth. Again, these are kind of spurious examples I'm pulling out of thin air, but that gives you a bit of an idea of some of the nuance that the system can understand and then ultimately report back to the user. So at this point, you can go in, you can take a look at what's driving the underlying decision. And then if it agrees with your thesis, fantastic. If it disagrees with your thesis, you're now in a good position to sort of analyze what drove that decision and see if you agree with it or not. Okay, so I wanted to talk a little bit about modern machine learning versus some of the more traditional quantitative techniques. And I know technically linear regression falls under a form of machine learning, but I would say there's a pretty big difference between the linear regression that's been used for decades in the financial space and some of the more modern nonlinear approaches that we're really trying to advocate for. And so fundamentally, just sort of starting off, 2020 was not a good year for traditional quantitative techniques. Most traditional historical approaches did not work very well. A lot of traditional risk factors did not work very well. 72% of quants say that their models were hurt by COVID-19. 12% say that their entire approach was basically rendered obsolete. The average quant hedge fund returned minus 5.7% in 2020, and the average quant mutual fund returned 3.3% in 2020. So the traditional quant has been having a tough time. And when you start to actually come in and analyze why, it's because a lot of traditional patterns really didn't hold. Traditionally, momentum does poorly in a downturn. In 2020, momentum was by far the safest thing to be owning. A lot of stuff like value broke down fundamentally. And then you end up with these really weird correlations. SPG, which owns shopping malls, is suddenly heavily correlated with retirement homeowners, which is heavily correlated with fitness equipment. I don't know if the entire history of the stock market, if fitness equipment and retirement homeowners have been correlated, but in 2020 they were. And in general, you had this weird cluster, right? You had like fitness equipment, you had travel, you had cruise lines, you had hotels, you had shopping malls, all correlated into this big cluster. And there's really nothing, and sort of call it out specifically, there's really nothing in like the traditional axioma or bar risk factors that really helped you prepare for that. And if you were using more of a traditional covariance approach, again, you've got these weird correlations that have never happened in the entire history of the stock market. So a traditional approach really wasn't well positioned to handle the type of regime shift and shock that happened last year. And arguably, it's actually been happening again going into this year, where a lot of the same kind of factors that actually did well last year suddenly are doing quite poorly, and you're getting these weird sort of shocks from things like the whole GameStop drama. On the flip side, what's really, really interesting about machine learning and alternative data is that you can actually be equipped to model the world in a way that you really couldn't do with traditional approaches. So we know for SPG, it's related to shopping malls. We know shopping malls are related to social distancing, and we know social distancing is related back to COVID. We know that CCL, Caribbean Cruise Lines, is related to things like Zika. So it's been traditionally related to pandemics, which then again means that it's related back into COVID. We know that fitness equipment is related to social distancing, again, related back into COVID. And so when you start to look at things like topic modeling and textual representations to produce a market mosaic, all of a sudden, analyzing COVID as a risk factor becomes possible. And if you do a really good job of that, and you do it point in time, going back historically, and you combine that with other sort of more standard quantitative techniques, it turns out you can actually start to risk mitigate and model a lot of these non-standard risk systems in ways that you just couldn't do with traditional systems. And what I think is most fascinating and most exciting about this is the vast majority of the industry really has not caught into this. The vast majority of the industry is not using things like textual analysis to do risk mitigation. And so, like I said before, that was by far one of the most popular use cases for us in 2020. But for me, it's actually one of the most exciting things over the next 10, 20 years. Whether or not you're skeptical in the ability of alternative data and machine learning to provide alpha, I can guarantee you that on the risk mitigation side, it is completely unique and it's able to do things that traditional systems straight up can't, right? And even if you want to sort of take a step back and forget about the risk mitigation side, even just knowing that your portfolio is heavily exposed to risk from a vaccine rollout, or knowing that your portfolio is heavily exposed to a risk from the gaming industry, or knowing that your portfolio is heavily risk to a supply chain disruption coming out of China. This information is very useful. Even if you don't want to actually risk mitigate it against it directly, just being able to look at your portfolio and get that kind of analysis can give you the ability to do some analysis that you probably couldn't. There are potentially hundreds or thousands of these non-standard risk factors that you can really mine out of alternative data that you're just not going to get if you're doing a traditional sort of covariance or, bar-based approach to it. And so I just kind of wanted to mention that really quickly, which is that Quant had a very bad year in 2020, but I would distinguish machine learning from more of a traditional quant. And actually for us, our best days last year for people using our product were actually in February, March, and November, right? November, I think 3rd, when you had the big vaccine shock, and February, March, when you had the big shift as a result of the market, we were actually able to model these new risks in a way that traditional systems were not. And that gave us a huge advantage in terms of relative performance. Well, I should say it gave our clients a huge advantage in terms of relative performance. And so, this is an example that's just doing an analysis. So it's basically just taking a look at a model, and you can see in there, like, there's all the traditional bar risk factors. If you want to go and take a look at momentum or volatility or profitability, whatever, that's all in there. You can take a look at it. But then it's also identifying these different sort of machine learned factors based on some underlying set of data that was input into the system. And then just to sort of highlight this again back at a high level, and this is more on the stock prediction side, kind of an easy way to think about it. If I think of traditional sort of stock screening approaches, and just based on a sort of standard simple data set, if I come in and I give the system, I want PE ratio above X and I want earnings growth above Y, they'll kind of start capturing these coordinates, right? And maybe you'll build a coordinate in such a way that it has historically captured more good points than bad points. But by definition, you're going to be missing a lot of opportunities, right? And if instead of doing a stock screening approach, we did a linear regression, instead of seeing that square, just think of it as a line kind of cutting the space. Again, there's almost no way of doing it to get the same level of precision. What's happening with a more non-linear learner is it's basically able to figure out these nuance. It's able to figure out, like, okay, PE is good, under these earnings conditions, and earnings growth is good under these conditions, but here's certain conditions where it's not as good. It can learn much more specific representation of the universe. And, that specific representation can be dangerous. It is possible to overfit. It is possible to produce these spurious backtests if you're not careful about how you sort of statistically control for those things. Luckily, that's something we're really, really good at. We do a very good job at building models that can learn these sort of rich understandings of the universe without suffering from some of these more standard statistical biases that a traditional ML system will suffer from if you just sort of throw it at the problem naively. So, if there's nothing else you get from the presentation, I'd say this particular slide is something that I'd really hope would resonate, where it's the machine is able to learn nuance, learn patterns in a way that is quite different from a traditional linear approach. Okay, so I want to leave a little bit of time for questions at the end, so I'm just going to kind of really quickly blast through this example. And this is an example of a model built on the Russell 1K. Here's some examples of some tickers that it wanted to buy. As I mentioned before, one easy way to use the system is just to come in and use it as almost like a stock screener. What are some stocks you suggest I should take a look at today? What are some stocks you're worried about blowing up? Why are those stocks blowing up? You can also come in and kind of at a high level analyze what were the major things that were driving the portfolio and the stock prediction on this particular day. And then if you want, I prefer the graph on the left where you're seeing the features, you're seeing how the features interact with each other. But if you want more of a linear representation, you can see it on the right too, right? Here in general, were the most important features that drove it. And this makes it easier to sort of see it, kind of similar to how you would see it if it was a linear regression. Again, it's not exactly the same because it's picking up a lot more nuance than a linear regression would. But if you're more comfortable with that representation, it's very possible to export that out of the product. And then, just really quickly sort of touching on just the stock prediction side of it, the way we analyze our models is basically on the stock side, on the stock ranking side, by the spread between the different quantiles. So if you've done a really good job building your model, the average performance of the top 20% of stocks should be way higher than the average performance of the bottom 20% of stocks. And then once you've done that, you can go long, short, you can, minimize your volatility, you can go long only, you can do whatever kind of portfolio construction you want. But the first part around actually separating it out and creating a good spread between your top and the bottom, it's really fundamental to the rest of the process. And then after you've done that, you can build your portfolio construction. You can kind of see what the historical results look like. And then you can start to do some really interesting things. Now, I think this model is probably unrealistic for the vast majority of people. It doesn't have a very high carrying capacity, and the turnover is like 4,000% a year. So it's a bit of a spurious example, but it does show that heavily optimized in the right direction, the machine can produce some extremely impressive results. Okay, really quickly, I'm going to lay the groundwork for future talks. So next talk I want to do, probably specifically focused on alternative data. I want to talk about data being not correct at point in time. I want to talk about data that's been trained largely in sample, data with survivorship bias, handling non-stationarity. Actually, non-stationarity is a really big thing I should have talked about. If we think about, say, $1 billion in revenue, it means something fundamentally different in 1990 than in 2020. And so when you're handling these kind of data sets, you need to be accounting for the fact that the meaning of the data is actually changing over time, and you need to be building something really robust for that. So next talk, I'll be talking about these things. I'll be talking about these things in quite a bit more depth than the topics I covered today. And then the other thing I want to talk about in a future talk would be around model interpretability. So how do we build models that can explain back to the human users what drove them, why? How do we build models at the prediction level, and then what I think the future of productivity is going to be and interpretability is going to be, and where I think it's going to go over the next 10 years. Okay, thanks very much.